Welcome to the Deep Dive. Today, we're really digging into KeyCorp's second quarter 2025 results.
That's right.
Our goal here is to break down the numbers, get into what management was saying, and look at their guidance, basically give you the key takeaways from their call.
Yeah, figure out what's really driving things for them, especially with the economy being, well, pretty dynamic right now.
Okay, so let's jump right in. The results, snapshot.
Yeah.
How did they do overall?
Pretty strong, actually. Headline number, earnings per share came in at 35 cents.
And that's even after, wasn't there a charitable contribution and some reserve build in there?
Exactly. Yeah, they had a strategic charitable contribution, plus they increased their loan loss reserves.
Yeah.
So hitting 35 cents despite that suggests, a solid underlying performance.
Right. And the top line, revenue.
That was really impressive. Revenues jumped 21% year over year. 21%.
Wow. Okay. And expenses. How did they manage those?
Well, if you exclude that charitable contribution, expenses were up only about 6%. So revenue growing way faster than costs.
That points to good operating leverage.
Definitely. And it shows up in their pre-provision net revenue, the PPNR. That's basically the bank's core operating profit before you factor in loan losses.
And how did that look?
It was up $44 million just from the previous quarter. That's the fifth quarter in a row it's grown. And get this, it's up over 60% since the first quarter of 2024.
60%. That's quite a run. Shows real momentum in their core business.
It really does. Consistent improvement.
Okay, let's break down that revenue. Net interest income, NII. That's usually the big driver for banks.
Yeah, and it was strong here too. NII was up 4% sequentially, so from Q1, and year over year, a huge 28% jump.
28% year over year on NII. That's significant. They must be managing their interest margins really effectively.
Seems like it. And it wasn't just NII, their non-interest income, the fees was also up. A healthy 10% year over year increase there, mostly from their priority fee businesses.
Okay, and the balance sheet, loans and deposits.
Good story there too. Strong growth in commercial loans. And at the same time, they were actively managing their deposit costs down.
Which is key in this environment.
Absolutely. Plus, credit quality metrics, things like charge-offs and non-performing loans, generally kept improving.
All right, let's go a bit deeper then. That 21% revenue growth and 6% expense growth. That operating leverage sounds powerful.
It is. They mentioned achieving 1,400 basis points of total operating leverage year over year and 300 basis points just on the fee side.
Basically means profits are growing much faster than the business size. Efficiency.
Exactly. Very efficient.
Now, you mentioned strong commercial loan growth. Tell me more about that.
Well, here's something quite interesting. They actually hit their entire full year 2025 target for commercial loan growth, which was about $3 billion by June 30th.
Wait, they hit the full year target in 6 months?
Yep, 6 months ahead of schedule. And it wasn't just one area. They said it was broad-based, different industries, different regions, both big companies and middle market clients.
And new clients too, you said.
Yeah, importantly, a lot of it came from bringing new clients on board, so suggesting market share gains. And another small sign, C&I line utilization, that's commercial and industrial, ticked up to 32%. Businesses are drawing on their credit lines.
Okay, interesting. Now, on the other side, deposits, you said they manage costs down. How did that feed into their net interest margin, the NI?
They were very focused on what they call beta management, basically controlling how much their deposit rates go up or down compared to market rates. In the first half, they really clamped down and their deposit costs fell below 2%.
Below 2%.
Yeah. And their cumulative down beta, how much their rates fell compared to market rates falling, hit the mid 50% range. That actually matches how high their beta got when rates were rising.
So they're capturing the benefit as rates potentially ease.
Yes.
And the NIM itself.
It increased, up 8 basis points in the quarter to 2.66%.
And what drove that increase?
A few things working together. That deposit management we just talked about. Fixed rate loans, they hold repricing at higher yields, some swaps maturing favorably, and of course, the strong commercial loan growth contributing more income.
Makes sense.
Though, one small drag they mentioned, carrying about $4 to $5 billion in excess cash. Good for liquidity, but it slightly dampened the NIM, maybe by 4 or 5 basis points. So there's potential upside there as they deploy it.
Got it. Okay, let's shift gears to the fee businesses. You said non-interest income was up 10%. What were the highlights?
Investment banking really stood out. They had their second best first half ever, pulled in $353 million.
Second best ever. What was driving that?
Strong activity in syndication, commercial real estate deals, and equity issuance. They also noted clients kind of rushed some transactions through late in the quarter, maybe locking things in before, potential changes or uncertainty.
Interesting timing. What else on the fee side?
Commercial mortgage servicing kept performing well. Fees there were up about 15% year over year. And this is an interesting bit. Their active special servicing balances, so dealing with troubled loans, are still elevated, around $11 billion.
Special servicing. That can be a bit of an early warning signal sometimes, right?
It often is, yeah. We'll come back to that. Also, commercial payments saw high single-digit growth, and wealth management hit a record AUM assets under management of $64 billion, plus record sales in their mass affluent segment. So really diverse fee streams performing well.
Okay, so growth looks good, fees look good. How about risk? Credit quality?
Continued to improve, actually. This was the 6th quarter in a row they saw credit migration get better.
6th quarter, wow.
Yeah. And commercial loan upgrades actually outnumbered downgrades this quarter. That's a positive sign.
Yeah.
Net charge-offs were $102 million, which was down 7% from Q1. Non-performing assets basically stable. And criticized loans regulators are watching fell by about $200 million.
So generally positive trends, but they did build reserves, right? $36 million.
They did. They said about half of that was just due to loan growth and mixed changes, totally normal. The other half was due to a slightly worse macroeconomic forecast from Moody's that they incorporate. So it looks like prudent, conservative reserving.
Makes sense. And their overall capital position?
Very strong. CET1 ratio ended the quarter at 11.7%. That's Common Equity Tier 1, a key measure of bank capital strength. They said it remains at or near the top compared to their peers, gives them a lot of flexibility.
Okay, so strong quarter, improving credit, solid capital. How does this translate into their outlook? Did they update guidance?
They did, and mostly upwards. Full-year net interest income growth, they now expect 22%. That's up from the previous estimate of around 20%.
So raising NII guidance. That's a good sign.
Yeah. And they expect Q4 NII growth to exit the year at 11% or better, with the Q4 NIM hitting around 2.75%. So they see that core profitability continuing.
What about loan growth guidance? You said they already hit the commercial target.
Right. So for full year average loans, they now expect down just 1.3%. That's better than the previous down, 2.5%. And maybe more importantly, period end loans, so the actual balance at year end, they now expect to be up about 2%. Previously, they guided to flat.
Okay, so better loan outlook.
And specifically commercial loans, they now see growing about 5% for the year, up from their prior 2-4% forecast.
Got it. Fees and expenses.
Adjusted fees, still expecting 5% or better growth. Expenses, still guiding to 3-5% growth, but they mentioned they're planning around the midpoint, so maybe 4%. And net charge-offs, they're forecasting in the 40-45 basis point range for the full year, which seems manageable.
So generally positive revisions across the board. What else stood out from their outlook comments?
I think the commitment to investment is notable. They're keeping overall expense growth pretty tight, low to mid single digits, but they're funneling money into key areas. Tech spend is up nearly $100 million this year. And they plan to grow their frontline staff bankers, advisors, by about 10%. We're talking investment bankers, middle market relationship managers, wealth managers, payments advisors.
So investing in people and tech for future growth, even while controlling overall costs.
Exactly. And they said investments they made late last year are already paying off, mentioning some new middle market teams in Chicago and Southern California as examples. It seems like a very deliberate strategy.
What about the broader environment? What are they hearing from clients?
They described client sentiment as cautiously optimistic.
Cautiously optimistic. Okay.
The consumer side looks particularly strong. Average FICO score is 767, which is quite high. They mentioned the wealth effect, rising asset values making people feel wealthier as a factor. Household wealth is up massively over the last 15 years.
Right, that does provide a cushion. And commercial clients.
They said commercial balance sheets are generally healthy, agile.
Yeah.
They surveyed about 850 large borrowers, and half of them saw the current environment as a growth opportunity.
Half. That's pretty positive.
Yeah. And an interesting detail, they said only about 3% of their C&I loan book is significantly impacted by tariffs, so maybe less direct trade risk than some might fear.
Okay. Now, you mentioned something earlier, a potential catalyst not in the guidance.
Yes. The 100% bonus depreciation. It's a tax incentive for businesses to invest in equipment and assets. Management noted it's not factored into their guidance yet.
But they think it could have an impact.
They do. They suggested it could drive a, quote, significant ramp up in capital expenditures, CapEx, in the second half of the year, especially for private companies.
So that could be some hidden upside for loan demand or economic activity if it materializes.
Potentially, yes. It's something to watch.
Despite the optimism, did they flag any areas they're watching closely, any concerns?
They did. They mentioned specific watch points, leveraged companies, which make up about 2-3% of their loans, businesses that rely heavily on Medicare funding, and then circling back to that special servicing point.
Right, the elevated balances.
Yeah. Within commercial real estate, they specifically called out a recent surge in lodging hitting special servicing. That's on top of the known pressures in office and some multifamily, particularly in the Sun Belt.
So lodging is a new point of concern popping up in their distressed loan servicing. That's interesting intel.
It is. They talked about having this sort of outside-in perspective from their servicing business, which can act as an early warning.
Makes sense. How about capital return? Share buybacks.
Their plan is to manage that strong CET1 ratio towards the high end of their target range, 9.5–10% for now. This gives them optionality for supporting clients, making those internal investments we discussed, maybe even small niche acquisitions.
So keep some powder dry.
Basically, yeah. For share repurchases, they're planning a modest amount in Q3, then stepping it up later in Q4. They described it as a crawl, walk, run approach, cautious but deliberate return of capital.
Okay. And longer term, any view beyond 2025?
They reiterated their confidence in reaching a 3% net interest margin by the end of 2026.
3% in them. That would be quite strong. How'd they get there?
Interestingly, they said they don't necessarily need a much bigger balance sheet. The plan is largely to let lower-yielding consumer mortgages run off and redeploy that capital into the higher-yielding C&I growth they're seeing.
Correct. Remixing the balance sheet for better returns.
Exactly. And they also highlighted a strategic pivot towards home equity lines of credit, HELOCs. They see that as a potential $2–3 billion opportunity, leveraging their existing customer base.
All right, so summing up the investor context here, why should listeners care about all this?
Well, I think KeyCorp's performance really demonstrates an ability to drive organic growth, through smart hiring and tech investment, even while keeping a lid on expenses. That signals a pretty robust operating model. Right?
Yeah, in a tricky environment.
Exactly. And their detailed comments on client sentiment, those specific watch points like lodging, that gives you valuable, granular insight into what's happening in the broader economy, particularly within banking.
It's like a microcosm view.
Kind of, yeah. And the updated guidance, especially NII and commercial loan growth going up, that points to real underlying momentum. Plus, their focus on accretive investments, things that add value, rather than just growing the balance sheet for growth's sake. That's a key signal for potential long-term value.
Strategic agility, as you said.
Right.
Okay, fantastic breakdown. Before we wrap, it is time for our segment. This is not financial advice. Remember, folks, just thought experiments. Do your own homework.
Absolutely. Okay, outrageous but plausible idea number one, the CapEx catalyst play.
I like it. Go on.
So management sounded pretty positive, though unguided, about that 100% in bonus depreciation potentially driving a big CapEx surge in the second half.
Right, the hidden upside.
Exactly. So the idea, maybe go long KeyCorp, betting on this catalyst hitting harder than the market expects. To maybe hedge it, you could pair it with a short position and say a regional bank that's more reliant on traditional loan growth, maybe hasn't talked about capitalizing on the specific potential CapEx wave.
Interesting. Betting on that unstated potential. Okay,
Yeah.
Trade idea #2.
Let's call this one the special servicing arbitrage.
Arbitrage. Okay.
We heard them explicitly flag that surge in lodging hitting their special servicing unit. That's an early warning, right? From their unique perspective dealing with distressed assets.
Okay, so use their insight.
Yeah. So maybe consider shorting a pure play lodging REIT, a company only owning hotels, or perhaps a regional bank known to have heavy exposure to hotels. At the same time, you could go long a more diversified commercial real estate fund, or a bank without much lodging exposure. Basically, playing KeyCorp's warning signal against the market.
Using their outside-in view as an edge. Again, purely hypothetical ideas for discussion.
Definitely just for discussion. So, to wrap up our deep dive on KeyCorp,
Right.
really a very strong Q2. They raised guidance on key things like NII and loans.
Yeah, driven by that robust commercial growth, smart deposit management, and those fee businesses really firing.
And they're clearly investing strategically people, tech, aiming for future growth, while still keeping that capital position very solid.
So lots to think about there. What are your thoughts? Do KeyCorp's investments make sense to you? Do you see that CapEx catalyst? Or are you more worried about those watch points like lodging? Let us know what stands out.
Thanks for tuning in to the deep dive. Remember, this information is just for educational purposes. It should definitely not be considered investment advice.